Good afternoon and welcome to CanadianAgMarkets.com. My name is Brian Como with Ireland Como Lafoy. Today we're going to talk about some technical analysis in the grain and oilseed markets. And we're also going to talk a little bit about the US dollar, its relationship to equities, and the Fed meeting tomorrow. So let's get right into it. Here is what happened in markets today. We had mostly green day on the board today, other than the cattle markets. Canola was up $8.50 to 640.80. Minneapolis wheat was up 4.75 cents at 571 and three quarter. Kansas wheat was up 9.5 cents today at 513 and a quarter. Chicago wheat was up 9 cents as well at 525. We haven't seen gains like a dime in each of those wheat markets in quite some time. Soybeans were up 7 cents at 1043. Corn was up 6.25 today at 423. Soybean oil was up 94, almost a cent a pound at 52.28. Canadian dollar was up 20 points at 72.76, and the cattle markets were lower today with live cattle down 115, 234.28. Hundredweight is where that finished off, and feeder cattle down 47 points at 358.72. All right, let's take a look at some technicals on canola here. We've been enjoying a little bit of a September rally here. We did bump up against the 20-day moving average yesterday, or over the last couple of days. It has now moved above the 20-day moving average. Now, it's not necessarily a huge move above the 20-day moving average. We did see it close above the 20-day moving average, and as you can see, that hasn't really happened since late July, where we saw a couple of closes above the moving average, but ultimately failed. That could happen here as well, but we are getting into that point of the year when seasonally we do see a bit of a kickback, or a bit of a return to more upward trajectory in the canola markets as the harvest kind of pressure kind of moves through and winds down. Just kind of wanted to layer on a Fibonacci retracement as well. We've gotten kind of up to that 23.6%. This rally could take us right up into that 38.2% mark, which would be about 665. That would kind of bring us back to these August highs here, which only, is a couple of day rally here. So I think that's reasonable. I think that it could push up to that height. If it did do that, it would extend itself out of the channel, which might be a bit of a hard thing to do. It might also be a bit of a hard thing to break above that 200-day moving average, although it hasn't spent that much time below that. So there's some areas of watch out. There's lots of resistance in this canola market, so it could pivot on any one of these realistically. But we are getting into that point of the year where a lot of the elevators, a lot of the crush plants are full for the fall period. That's been, that sales pressure has been pressuring not only basis but futures as well. And now we might be coming out of that trough and looking forward into 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 Dece, Jan, and forward. We talked yesterday about how the crush margins are extremely good right now for those periods. So we could be coming out of the fog here in canola. Of course, it doesn't act on its own. We did see some really good gains today in the soybean oil market, which did help canola move higher as well. And that may have been helped out by crude oil here, as we saw some good gains in crude oil today, up back towards $65 a barrel. Still kind of trading sideways since the beginning of August, or even into the end of July, where we saw highs like this last time during the descent there because of the OPEC production changes. So we're kind of coming out of the trough there, or it feels like we're getting to the top end of the trough in crude oil. That's helping soybean oil, we feel, and that is propelling canola forward as well. All right, let's get into the wheat market. We saw all the wheat markets perform really well today. Again, we're getting outside of the harvest window. We did see some information from the USDA about planting progress, which is behind schedule at this point in time. I think that's part of the reason for the rally here. We saw CBOT wheat, or Chicago wheat, do something similar. It came right up to previous high there from the end of October. So if we can move above that, that would be positive. Overall, though, the move above the 20-day moving average is positive. It was a pretty aggressive move above the 20-day moving average as well, and a nice close at the top of the market. So we like where that is going seasonally as well. We also see wheat tend to rise at this point in time. Of course, we're still in the gut slot of spring wheat harvest, particularly here in Canada, even though it's wrapping up in the northern states of the US. We still have lots to take off here yet in Canada, or at least half, if not more of it, over across the prairies. We didn't see a break of that 20-day moving average in the spring wheat market, but if we do see follow through from the wheat markets tomorrow or into the rest of the week, that could make a difference in spring wheat as well. Here's the beans. It's kind of as a result of the soybean oil. We also saw some small gains in meal today. We are seeing gains there too. Um, that is ahead of the USDA report as well. So we got lots of stuff coming up, uh, or sorry, just after the USDA report. So we got lots of news filtering into the market here for beans. Corn was also similar as we start getting into the harvest period of corn. I think the big yields that were forecast were kind of priced into this, middle of August low. It's been climbing out of that ever since. So that kind of tells me that maybe there is a little bit more concern about corn yield than what even the USDA would have reported last week. But needless to say, we're seeing a bit of a resurgence in the corn market. We did run up against this resistance here from the middle of July, right around 430. A colleague of mine pointed out that there's a little bit of a gap here to fill as well into the 435 area. So we could see that get filled as well. And then the next area of resistance would be right up around 440, which coincidentally is right about where that 200-day moving average is. So if we can continue to get momentum out of the corn market, we could get up to that 430 area without a whole lot of difficulty. All right, let's move into talk about the US dollar today. It broke down not to new lows, but definitely below the or the support it had around 97 and a quarter, or even 97, moved below that, closed or was trading at the time of this taping at 96.64. Lots of weakness in the US dollar today. At first when I looked at that, I thought, oh, there must be a shift in sentiment about the USDA, or sorry, not the USDA, the Fed announcement tomorrow. Yesterday, I think we put this chart in yesterday as well. This is an updated one. I thought maybe there was a bit more bias moving towards a half point cut, and that's why the US dollar was struggling today. That's not really the case. We still see about 96% chance of a quarter point cut and about a 4% chance of a half point cut at this point in time. So not a whole lot of change overall, but that's where it stands. So what's happening with the US dollar? This article in the Globe and Mail kind of sums it up. There's some hedging pressure coming into the US dollar at this point in time that is meant to offset the risks in the equity markets. Okay, so just kind of let's just lay out what the equity markets have been doing here. This is a 1-year chart of the S&P 500 futures. As you can see, even today it made a new high in this market. This isn't a lone wolf here either. Here's the Nasdaq Composite, which is a tech heavy index of equities. It's also made a brand new high today as well, and it's just been pushing higher and higher over the last couple of days. Dow Industrial Complex futures are in a very similar outlook. So the equity markets are just on fire here. And, there's lots of pundits that are calling for the collapse of this as a result of the Trump tariffs. We saw some big losses here when Trump was announcing the tariffs, but we've made all of those back at this point in time. The market is just roaring, and I can't explain it. I'm not an equity analyst necessarily, but again, this article kind of explains why that's happening. So why is there a rush right now to sell US dollars? The US dollar has fallen about 11% over the last year due to, these expectations of Fed rate cuts, as well as weaker, yield differentials between different countries and different currencies, as well as concern over the US fiscal policy. So what's been happening is the dollar has been fading as the equities have been rising. So a lot of that foreign investment that comes into the U.S. equities is, traditionally is not hedged. So that means that, companies are exchanging their home currency for US dollars. They're investing in the stock market, and that's about it. The stock, the stability of the US dollar meant that there wasn't a whole lot of currency risk, and that the gains in the equity markets would be more than adequate. But what's been happening is that we've been seeing really good gains in the equity markets, but again, the dollar has fallen around 11% over the last year. So that takes away from the gains that we see in the equity markets. So there's been a big influx into hedging that equity or the currency exposure in equity. So, you know, currently there's about over 80% of now the foreign equity inflows to US are now hedged, and about 50% of the foreign bond inflows are being hedged. So roughly two-thirds of the money that is coming in from abroad into the US securities is now protected to avoid that FX risk. So that's one of the reasons why we're seeing continued weakness in the US dollar, even after, the market has likely priced in these rate cuts to the rate cut from the Fed policy that will be announced tomorrow, or likely will be announced tomorrow. So, of course, there are risks to this, right? Hedging isn't free. It does cost money from, as far as interest, and then the rate differentials, and, the swaps and all that complex stuff that comes with the currency markets. But of course, they also have the risk that the currency could turn around, or that the equities turn around and sap their gains as well. So what could end up being what is a hedge could end up being, a downside to all these foreign investors if something, doesn't, if the pattern of what we're seeing right now, which is higher equities and lower dollar, doesn't continue. So of course, this has some implications on the Canadian dollar. We did see some strength over the last 2 days in the Canadian dollar as the US dollar has been falling. We're now back up into the high 72s at 72.75 roughly. From a technical standpoint, we've cleared some of the major moving averages. We have some resistance here just above the market, or just still below 73. But if this market gets to 73, we're starting to make new recent highs, or at least highs that we haven't seen in the last couple of months. And that could signal that there's more to go in the Canadian dollar. Now, the Canadian dollar is important to hear for our agriculture producers, because a rising dollar is actually a problem, right? It creates a it makes our commodities on the world stage more expensive relative to the others, or to the US dollar. When we sell our commodities abroad, we do sell it in US dollars. So if our currency is rising, that means we have to lower the price in US dollars to compensate. So generally, a rising Canadian dollar negatively affects the farm gate price of your commodities overall. All right, that's all we have for you today. If you haven't subscribed to this channel yet, we would really like you to. It really helps. It really helps our ego. I think that's what it helps the most. But no, it helps the algorithm as well, get more videos like this to more people who would want to see it. So hit that subscribe button on YouTube. It's absolutely free. And if you want to get more of our premium content, our analysis, and all of our insights, you can go to canadianagmarkets.com/subscribe, and we send out multiple reports a week, including a daily commentary that outlines what is important for the day, as well as a weekly summary and market outlook as well. All right, that is what we have for you today. Thank you so much for tuning in. We will see you again tomorrow.